Good afternoon, everyone. Welcome to the Renaissance call. We're here today for the launch of our Renaissance India Opportunities Fund, which is our open-ended large cap AIF offering. We have with us Mr. Pankaj Murarka, our founder and CIO, who will be taking us through the offering and his views on what's going on currently. All of you would know Mr. Murarka, but just for a very quick introduction, Pankaj ji has, been an industry veteran close to, I would say, now to 3 decades. In this period, been with a lot of extremely well-known firms, largely in the equity space. And his last role before he started his entrepreneurial journey about 7, 8 years ago was with Axis Mutual Fund, where he set up and ran Axis as the CIO for close to a decade. One of the most awarded fund managers during the period that Axis funds were under Pankajji's guidance. So we're very fortunate to have him here today to share his thoughts on what's going on, what is our plan for our large cap strategy, and how he sees the way forward. So with that, over to Pankaj. At the end of this, we'll obviously have a moderated Q&A, and we'll throw the floor open to questions. So with that, over to you, Pankaj.
Sure, Shalini. Thanks. Good evening, friends. Very warm welcome to all of you all, and I'm very happy to present to all of you all today our open-ended AIF on our Renaissance Opportunities Fund. I'm sure many of you are familiar with our large cap PMS strategy that we've been running on our PMS platform, Renaissance Opportunities Portfolio. And now we're bringing the same strategy to on an open-ended AIF platform with some minor tweaks, which I will share as we go along. And the strategy has done pretty well on the PMS over the last 5 years, 6 years that we've been running it. Over the last 5 years, in fact, it beats all large cap PMSs and in fact even large cap mutual fund as well. Given the fact that we were doing so well in comparison to all the large cap mutual funds, we thought it was a wise idea, and also basis feedback that we continuously got from all of you all, we thought we'll finally launch this strategy on our AI platform as well. So with that background, maybe let me quickly bring up a presentation that I can use to guide our discussion.
So you are on mute, sir.
Oh, sorry. Am I audible now?
Yes, sir.
Okay. I don't know when I went on mute, but so the idea with Renaissance Opportunities Fund is it's a extension of the strategy that we've been running on our PMS for the last 6 years. Last 6 years, the strategy has done phenomenally well on our PMS platform, and we thought it makes immense sense. Basis the feedback we received from all of you all and the fact that we were doing much better. We were actually on a 5-year basis, our PMS strategy has outperformed all the mutual funds in the large cap category. So we thought it makes immenent sense for us to bring this strategy on the AIF platform basis the feedback also we received from all of you all. So with that background, maybe let me just present the fund to all of you all. Most of you all are familiar with Renaissance, but still there are quite a few number of people who are probably new. So I thought I'll give a quick introduction about Renaissance and then talk about a bit about strategy. And more importantly, I want to spend some time talking about why large cap is so exciting in India. From my experience of now it's been about 29 years for me, I still find large cap very exciting in India. And I think it's a sector or a segment of the market which is grossly underrated in terms of returns and also in terms of risk. The kind of returns we generate in absolute terms are very healthy and with very low risk. And I think that's somewhere underrated, in our understanding. So I would like to highlight that as well as we go along. Very quick introduction to Renaissance, friends. Across PMS, AF, and advisory, now we are about 4,000 crores in terms of assets that we manage or advise. We are a team of about 80 people now. We have on-ground offices now in 6 cities outside of Bombay. I'm sure many of my colleagues are engaging with all of you all. And we have a very accomplished senior management team at Renaissance that helps me and runs different parts of the organization. I'm sure most of you are familiar with me, so I'll skip introductory slide about myself. A very quick introduction to you to the senior management team at Renaissance. Shalini is here with us on the call. Shalini is a executive director on the board, and she drives all our growth initiatives and also helps running the organization. Shalini brings incredible experience of 28 years across some of the leading organizations like Kotak AMC, Stancy Bank, and few other leading AMCs in the country. Ninad is a chief operating officer, a chartered accountant with over 20 years experience. He's worked across leading organizations like Citibank, Vistra, and few others. Sanjay, my colleague, he heads our research and is also a co-fund manager. Sanjay has over 20 years experience in equity research and has worked with some leading organizations like JP Morgan, Kotak, and few others. Sanjay is an alumni of IMCAL, and Alok heads our products and alliances. Again, Alok spent 16 years with Nippon AMC and over 2 years now has been part of the Renaissance team. So I thought I'll make you familiar with Renaissance team. Very often, a lot of you guys have asked me at different points of time, what is the secret sauce of Renaissance performance or something like that. I've always said two things. Whatever I'm doing at Renaissance for the last 7 years is no different than what I did for 10 years before that for the organization I worked with, Axis AMC. And what I did for Axis AMC for 10 years was no different than what I did for 5 years for Merrill Lynch before that. And maybe before that, in the first 9 or 10 years of my career, I was still learning the art and skill of investing. So I thought still for the benefit of everyone, what we try to do is very simple, friends. The only thing we try to do is be very consistent and disciplined about just keep doing the same thing time and again on an everyday basis. One, I always say that as investors, we are high conviction investors. And we will not hesitate to reflect our conviction in our portfolio. That is exactly what I did at Axis also. I'm just taking you guys back. When I ran Axis for 10 years, Axis mutual fund portfolios had the lowest number of stocks in any portfolio in the entire mutual fund industry. And this is exactly what we're doing at Renaissance. Our portfolios are focused portfolios. We do detailed work on our investee companies. We spend a lot of time with our investee companies before we spend or invest our money. We invest our time before we invest our money. We take our time to build our conviction. Once we have our conviction in place, we reflect that conviction in the portfolio. When it works for us, it does create meaningful alpha or returns for us. Obviously, there are times once in a while where it doesn't work for us and it hurts us, but that's okay. We are okay with that. That's the nature of the game. But we are and we will continue to remain a high conviction investor. We do not want to be a investor who's trying to do investing by stroke of luck or taking chances. No, none of that. We are very clear. We'll put our money where our conviction is. We bring a very proven track record of performance now. When I started Renaissance 7 years back, Pankaj Murarka had a track record, but Renaissance was a new organization. Now Renaissance, I'm very happy to share with you all, Renaissance has a 7-year track record now. And I'm very happy or very pleased to say, at least from where we stand in terms of performance track record. On most of our strategies, on a 3-year, 5-year basis, we are amongst the top 3 alternate investment manager in this country. And most of our funds, be it even mutual funds, on that background. So I'm very happy in terms of where we've been able to position ourselves in terms of performance track record. And I'm sure many of you have experienced that for your clients with our funds. As investors, I like to think about ourselves. We are very thoughtful in terms of where we are investing. More importantly, we are very self-aware investors. So at any point of time, we have a view on the world and on India and everything that's going around us. And we like to think about the future, because investing, eventually when we invest, we're dealing with the future, because whatever is today is known is priced into the stock. Yeah, so we like to be have some understanding and view. We tend to have views in terms of how we think things will evolve in the future, and basis that we like to head slightly ahead of the time, because that is the when the future growth or expectations are not fully priced into the stock, and which is where you can buy the kind of companies we buy, which are high quality companies at a reasonable price. And we tend to be then very patient with our investing companies. So we like, it's in our DNA to be slightly ahead of the curve or slightly ahead of the cycle, because that gives us a good entry point into buying those companies. And it also gives us a fair bit of time to build up positions, because at times, as you grow in size, it's difficult to build positions in markets, especially in a bull market. So slightly being ahead of the curve certainly helps us doing that. we are absolutely, while everyone is trying to make returns, for us, the source of return is very important. What is the source from which we are generating our returns? And I can tell you, we are absolutely alpha focused. The question is, how can we generate superior returns for a given level of risk? So while for us returns are important, but the source of returns are equally important. How are we generating those returns? I'll be very worried personally if a significant part of our returns are coming from market momentum. In fact, we are contrary. We tend to sell into momentum rather than buying into momentum. Whenever our stocks that we buy, once they get into a phase where the stock prices start showing a lot of momentum, and if we think valuations are expensive, we love to sell into those momentum. So we are sellers in momentum, not buyers of momentum. Because we are value investors at the end of the day. We want to buy $1 for 80 cents at any point of time. And once we get that, we want to put a meaningful part of money or our portfolio into that stock with very deep conviction and then stay invested with that company. And eventually, I say investing is a game of risk management. It's managing risk. So we like to think about ourselves more as risk managers than portfolio managers. I thought I'll just reiterate this. I'm sure I've spoken to many of your different points of time talking about all of this. But I thought today on this occasion of launch of a new fund, probably I'll bring more clarity in order to, this in terms of sharing what we really think, what we do. And I know all of this is very simple. I think the only thing that we do is we try to be very consistent and keep doing the same sort of things every day. I think that's the most important part of it. So let me just straight away drill down into this large cap opportunity in India, which I somehow believe is underrated from the perception people have about what large caps can do. I thought it's underrated. Let me share a context with you all. All of us think about Indian large caps as matured companies delivering low returns, and today we're going to challenge both the notions. First of all, let me just place India in context. Just understand this, friends. India is currently, as we speak, is about 3.6% of global GDP. So in the context of the world, India is still very small. Obviously, India has been growing much faster than the global economy. As a result, over the last 20 years, India's share of global GDP has doubled from about 1.8%, which India was in 2005. We are now about 3.6%, which is pretty heartening. But yet, despite that, in a global context, an economy which is about $4 trillion, in a global GDP of $100 trillion, we are still very small. While we are the fourth largest economy, but we're still very small, with just about under 4% of the global GDP. So I say that Indian economy itself is small in the global context. We are in a stock market parlance, I would like to call it as a small cap company, that we are still a small cap company in the global context. And if India sustains its current growth momentum, which I have no doubt in my mind that India would, then probably in a decade's time, I think India could get to about $10 trillion in terms of size and scale, and which would certainly, that would mean before that we will become the third largest economy in the world. But given the fact that US and China are 50% of the world GDP. All of us know that at $30 trillion for US and $18 trillion for China, they are 50% of the world GDP. We will become the third largest. But by that time, we'll become a mid-cap economy. And probably as we, all of us are fairly familiar that we're riding this whole Amrit Kal phase for India, as we call it, or our Prime Minister has given a clarion call. We certainly see India emerging as a $20 trillion economy by 20 years. In 20 years from now, by 2045 or so, that is when India becomes a large cap economy. So the point I wanted to highlight, friends, when we are buying large caps in a small cap economy, you're still buying global mid caps or small caps. You're not buying global large caps, which effectively means these companies have significant room for growth ahead of them. So let's not underestimate their growth potential, and I'll talk about that. So that's the first thing I thought I'll maybe emphasize for better clarity for everyone, that India is still a small cap economy, friends. I thought I'll place this. These are the top 10 companies by market cap in US and India. Now, obviously, we know the mega techs in US, Microsoft and Apple are now closer to $4 trillion. This data is was done in January, about 6 months back. But Apple and Microsoft are $4 trillion in terms of market cap. The largest company in India, Reliance Industries, is about $200 billion of market. So point I'm trying to say is the largest company in India, which we call large cap, is still a global mid cap. It's still a mid cap by global standards. Yeah. And the 10th largest company in India, which was LIC, was about $60 billion. That would classify more as a small cap in global context. So while what we consider as large in India, India is growing, but still these companies are mid caps or small caps from a global context perspective. The long-term growth story in India has been outstanding. It's been magical, I would say. Last 25 years, Nifty earnings or corporate profits for the top 50 companies of India have done a 25-year CAGR of 12%. Meaning you can't get this anywhere else in the world. There's no other index which has given this kind of earnings growth over such a long cycle. Within that, we have had our up cycles and down cycles, but the long-term India story is very, very fascinating. And the good thing is that while last 25 years has been fascinating, clearly the next 20 years are going to be equally fascinating or more fascinating than what it has been. Indian markets or the Nifty index itself has been a long-term steady compounder at 13% CAGR for the last 20 years, which has been very much in line with Nifty earnings growth and also very much in line with India's nominal GDP growth. So there is a almost, I would say, 0.9% correlation between India's nominal GDP growth and Nifty index returns. So which clearly makes Indian economy and as a consequence, Indian markets as a very compelling story from the next 10 years or 20 years perspective. And if that is the case, then you cannot not invest into large caps in India because they're extremely fascinating. More importantly, Indian markets, I'm sure all of you, some of you are familiar with this. Indian markets have become very steady in the last 15 years. This is the annualized returns of Indian calendar year annualized returns for Indian markets over the last 15 years. And if you see this, 12 out of 14 years in the last 12 out of last 12 years out of the last 14 years, Indian markets on a full year basis have given positive returns. It's very difficult to lose money in India if you've invested for at least a year. 85% probability of making money from a 1 year perspective. And if someone investing from a 2 year time horizon, the probability of making money is 100%. That does not exist in anywhere else in the world. And I think that's an outcome of very stable growth and macroeconomic fundamentals that India has had in the last 10 years. So Indian economy, while it's been growing, the good thing about it has been it's a very stable, steady state economy. And we've had multiple macroeconomic shocks globally, right from the COVID crisis to so many other things that have happened in the world. And yet, despite or in midst of all of those crises, India still has had a very steady growth. It's been a very steady compounder in that sense, friends, is what I would like to highlight here. Let me now just spend some time talking about the large caps in India. Now, this is just to give you a context of some of the, people generally think all of us, I'm sure all of us want multi-baggers. I'm aware of that. Even I want multi-baggers. The general perception is that to generate multi-baggers or what we call high returns, we have to invest in mid and small cap because unless we do that, we will not make high returns. While that's
Pankaj
true.
sir, sorry to interrupt. I know questions will be in the last. But for these companies in India to become large caps globally, is it not that they have to go beyond India, HDFC Bank or ICICI Bank or something?
Yes, you're partly right, Neil. I keep this question with me. Let me just finish this and I'll answer the first question I'll take will be answer your question. Yeah. So the point I'm trying to say is we can have multi-baggers in large caps as well. Yeah, we can have multi-baggers in large cap as well. Now, this is, you see some of the, these are now well-known companies. I'm sure every Indian knows about these companies. And when you see the returns that these companies have delivered over the last 10 years, it just meaning phenomenal or outstanding. And I must also say it is my firm belief from my understanding of businesses and my experience of equity research, these are also amongst the finest companies, even from a global standards in terms of the kind of competitive edge they have in business and in terms of the way these companies are run. They're amongst the best companies in the world. They're so well run. The people or the management teams running these companies or businesses are the finest management teams you will find in any part of the world. India is extremely competitive, friends, when it comes to business. Being the best in your industry and being a large cap in India is not easy. It's very competitive. I think India is very ferociously competitive when it comes to business, like most of the other things. So some of these large cap companies in India are amongst the best in the world. So when you're buying into these companies, you're buying amongst some of the best companies in the world. And still, these companies, as I said, have a long runway of growth ahead of them. We can see what clearly these companies have done in terms of returns over the last 10 years. Meaning, if a Reliance can compound at 20% CAGR for 10 years, meaning what else does one need, kind of thing. Yeah, and I thought I'll zoom out further and thought look at returns for the last 20 years. Now, HCL Tech compounding at 24% CAGR for 20 years, just to put these things in context, is money going 132 times over 22. 1 rupee, 1 crore becomes 132 crores in HCL Tech over 20 years, friends. Now, that's the kind of, or a 20% compounding over 20 years effectively in HDFC Bank means 1 crore becomes 32 crores in 20 years. Meaning we're talking now, what else? We're talking multi-baggers over a period of time, and you're buying all of the, probably these are some of the safest businesses that exist in this country in terms of both business risk and also about stock market volatility. So the point is, I always say that we have to look at returns in the context of risk. So what else you ask? You get some of the best returns, not only in the Indian context, but I would say even in global context, and those returns at probably a very low risk index, and which is what exactly these companies or Indian large caps are all about. So obviously, to summarize, I firmly believe that obviously these are leading companies of India with very strong business model and a very strong balance sheets. All of these companies have gone through multiple economic crises, whether Indian or global, in the last 20-30 years of the life cycle. And every time my experience with most of these companies is from these companies, given the kind of management teams they have, every time they have faced a crisis, each of these companies have used that crisis as an opportunity, and they've exited the crisis much stronger than what they were as a business when they entered the crisis. So as they say, never let go, never waste a crisis, never let go of a crisis, go waste. This is what exactly these companies have done. They've used every crisis that has come in the last 20-30 years in their life cycle of business as an opportunity to further enhance or increase the competitive edge or moat of their businesses. Yeah. I'll quickly talk about the Renaissance India Opportunities Fund that we're launching today. The strategy is a large cap strategy. Idea is to run 75% 75 to 80% of the portfolio at least 75 to 80% of the portfolio in large caps at any point of time. It will largely mirror our opportunities PMS that we've been running for over 6 years now. But it will be unlike the PMS, which is a more focused portfolio of 25 stocks. Here, probably we could have about 30 odd stocks in the portfolio. And more importantly, given that it's a fund structure under AIF, we have an option to use some selective leverage at different points of time to optimize the returns, because we will be holding on to a lot of these stocks for a long period of time, given our long-term holding nature. There are a lot of mispricing that happens in the derivatives market, so we might advantageously use some of those to make some returns from that as well. So it's not compulsory that we'll use leverage. We'll be very selective, but we will certainly use that to our advantage, because we will be holding a large inventory of stocks, and if we can optimize our returns on our holdings, why leave that money on the table, which we really want to capture here through the fund structure. I'm skipping some of the slides on Renaissance investment process and our risk framework, because I'm sure all of you are familiar with that. We've discussed that time and again. None of that changes. That's our DNA. So that's unlikely to change with any fund or any product that we do at any point of time. That's ingrained into our DNA. Objective is to deliver superior risk-adjusted returns. Maybe I'll spend a quick 30 seconds on this slide. Again, to dovetail into our whole Renaissance DNA of high conviction, superior alpha and low risk investment philosophy or process. I think one thing from which helps us or distinguishes us from a lot of our peers is we are not chasing returns at any point of time. Every time we are looking at an investment case or a company, we understand investing is a game of probability, because we're dealing with future. Future is uncertain. There are a lot of uncertainties at every point of time on an everyday basis. We are always chasing the most optimum investment outcomes, which effectively means while we're looking at companies and the potential returns those companies can deliver over our holding period of 3 to 5 years, but we are also at the same time recognizing and acknowledging the risks that are associated with those returns and what could be the possible outcomes. It's very natural for us at Renaissance and for me to dovetail towards most optimum outcome and not chase highest returns. because highest returns must be coming with a very low probability or very high risk, which effectively means those high returns or the promise of high returns or the lure of high returns with low probability of success will not eventually translate into high returns in terms of outcomes. And we want more certainty in our investment outcomes. When we are making investments, as I said, we are high conviction investors, but that high conviction also comes from the fact that we seek high certainty of investment outcomes. So we like to make investments in companies and businesses where we can see a high probability of success or with a reasonably high certainty in that sense, and which effectively automatically dovetails our portfolios towards more higher probability of outcomes or higher probability of investment outcomes, which effectively eventually in investing parlance means lower uncertainty, and lower uncertainty means lower risk, and which is what we tend to do at all points of time on an everyday basis. Currently, maybe I can come back to this. And so a very quick snapshot for all of you, all of the Renaissance opportunities portfolio as it stands today, meaning about almost close to 40% of our portfolio is into financials. Consumer discretionary is about 14%, IT at 13%, and then some of the other sectors, very well diversified portfolio across 12 sectors. As you can see the top 5 holdings and the fundamental profile of the portfolio in terms of how it's placed. Currently, we have placed the portfolio is one peg portfolio on FY27 basis. Portfolio has earnings growth of 19%, about 16% earnings growth CAGR over the next 2 years, and at 18 times on FY27 earnings, it's absolutely one peg portfolio. I've always highlighted this that as investors, we are low risk, moderate risk investor. The portfolio is a beta of 0.94. It has had a very healthy upside downside capture ratio where it has outperformed the market on both sides at 108:83 in the last 3 years, and we intend to continue with that trend. In terms of performance, the fund has done reasonably well. 5 years ending 30th June, the Renaissance Opportunities PMS portfolio has delivered 28.39% CAGR versus the Nifty 50 TRI of 21%. So very healthy outperformance for the last 5 years, and likewise over 3 years as well. 3 years and 2 years as well. I quickly spent some time on this. I thought we'll put, while we talk about, alpha creation, low risk, I thought I'll put plain statistics in front of you friends. So you can clearly see what we presented here is the alpha and beta of the Renaissance Opportunities portfolio over the last 5 years, because these bars that you see, the monthly bars you see, are 3-year annualized alpha and beta numbers of the portfolio. So if you see the beta of the portfolio, that box on the top, and which is mapped to the y-axis on the left-hand side, we have kept the beta of the fund very tight around 1. That essentially primarily reflects last 5 years. Our view has been, we've been positive on markets all through the last 5 years. We firmly believe that we are very much in a bull market. In a bull market, we want to run the fund at full risk, and that full risk to us is market risk. We certainly don't want to, just because we have a positive view, we do not want to exceed our risk limits or go above the risk budgets and take higher risk in the fund, because that does not reconcile with our whole DNA of moderate risk investors. And running risk lower than 1 would not be fair to our clients and prospects, because we are leaving money on the table. That would amount to leaving money on the table, which we certainly don't want to do. So we've been very disciplined in terms of making sure that we are running the fund at full risk, that is 1 beta at market risk. And these bars that you see are the annualized alpha that we have generated on a 3-year rolling basis. So April 23 number is the of 9% is the annualized alpha of 9% that we've generated for clients who came in a portfolio in April 20, and for 3 years ending in April 23, they got a 9% annualized alpha. The 2 takeaways that I want you to take from this is, if you see all these bars are positive, we have not had a negative alpha, which effectively means 100% of our investors who've stayed in a strategy for 3 years have experienced alpha. The range, the dispersion of that alpha is between 10.5% to 4%. All the investors who, for example, who came into our strategy in 2022, for 3 years ending in 25, they've experienced a 4% analyzed alpha. So, and I believe that even the lowest alpha of 4% is pretty healthy in terms of, and amongst the leading ones as compared to relative performance to the industry. So the point is, what I wanted to really draw three inferences for all of your friends from this is one, we've been very disciplined with our risk taking in the fund, and that is how we want to be. We want to become more and more predictable and boring, friends. That is what we really want to be, and we want it to be more a process than something which is driven by, some fancy thought in the morning that we might get. So we clearly want to be very disciplined with our whole investing process, and we want to be very disciplined with our and if we are disciplined with the process, then the outcomes will become more and more predictable, and which is what I want you to take away from this in terms of whatever we've done with our risk, and also with the value we've added to the clients through the alpha we've generated over the last 5 years with the strategy. I thought I'll give you all some more granular insights in terms of what has worked for us in the last 5 years of what we've done. Now, here are some examples of companies that we bought at different points of time, and how they've done over the last 5 or 6 years. So, for example, if you can see some of these companies like Tata Motors, Sun Pharma, ICICI Bank, they were all bought in 2018, pre-COVID. And when we bought, probably some of these companies for 2 or 3 years prior to that had not done so well, but we could clearly see deep value and a significant turnaround in business momentum for these companies. And many of these companies like Sun Pharma, ICICI Bank, State Bank are still part of our portfolio. We've been holding them for 6 years. And over the last 5 or 6 years, these stocks have done phenomenal returns, as you can see there. Or, some of the other names like Bharti, which we've been owning for now almost 4.5 years, has done a 36% CAGR for us. Or Info Edge, we've been holding for 6 years and it's done a 24% CAGR. So, and you will, I'm sure you will agree with me, these are some of the best names in India. These are companies which are leaders in their respective businesses, the highest quality companies run by the best in class management teams. And the outcomes are phenomenal in terms of what we've been able to, what these companies have been able to deliver to us in terms of returns to us as shareholders. Uh, 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 Across different portfolios, we've had multiple other companies. Maybe I'm skipping this for the time being in the interest of time, but we can come back if you guys have questions. These are performance of some of our previous AIFs that we've done. Some of them were close-ended. Our first AIF we had done was in September 18, where we returned the money to investors in September 23. On a 5-year basis, that fund did a CAGR of 24%, 23.7 to be precise, versus the Nifty CAGR of 12%. So yeah, had a pretty good run with that fund, and likewise we have performance of some of our other funds. I'm very happy to say across funds, our funds have been doing reasonably well across. All our funds have done pretty well. So a quick snapshot of this fund. Renaissance Opportunities Fund is a Cat 3 AIF. It's an open-ended fund, and Kotak Bank is the custodian for the fund. CAMS is our investor agent or registrar for the fund, followed by Vistra, who's the trustee, and KPMG is the tax consultant. Now, the fund has an exit load of 1% for 2 years, and fee structures of the fund for reference of all of you all. So that's quickly on the Renaissance India Opportunities Fund. Maybe very quickly, I wanted to have a more engaging session, so I can quickly answer Neil's question and then we can open the floor for questions. So Neil, you are right that at some point of time, these companies will have to go global to become larger. But at this point of time, that might not necessarily be required, because the fact is that the benefit of tailwind these companies have is in the home market, which is India, is the fastest growing economy in the world. They need to make significant investments in the home market, because this is the market where these companies have been born, and they have a very strong edge in their business, and a very strong lead over anyone else, because India is now a largely open economy across most of the sectors. 90% of India's economy is open to investors, any business globally, despite whatever Trump says, meaning obviously all of us know how dishonest he is. These companies need to make and continue to keep making significant investments in India to to sustain and enhance their lead, and there's significant growth potential here itself. yes, over a period of time, some of these companies will go global in terms of doing. For example, when you talk about Larsen today, okay, Larsen derives on their core engineering business. 30% of their business is now outside of India. They are a very dominant player in the entire Middle East, where they compete with some of the leading engineering companies from Korea, from other Middle Eastern countries, and even some European companies, likes of Samsung, and there are a few other Korean companies. All of those companies are there in Middle East because there's a huge investments in across the energy cycle that's happening in Middle East. And Larsen does compete with them fiercely for business and has a very dominant presence there, or has a meaningful presence. It's a very meaningful. So Indian companies have capabilities in terms of what they're doing. And more importantly, as these companies, meaning I'm just saying, think about IT services, right? India today dominates global IT services because while these companies are Indian origin, TCS or Infosys for that matter, HCL Tech, these are global companies because 90% of 95% of their business is outside of India, or clients are outside of India. They're serving global clients. 70%, meaning while 60-70% of the workforce is in India because you leverage the Indian cost structure, but meaning almost 30% of the workforce is outside of India. And when it comes to, if you look at globally IT services company, then amongst the top 10 IT services company in the world, 6 of them or 7 of them are Indians. 6 of those top 10 IT services company are Indian. So India dominates IT services globally now. So absolutely, some of these companies or many of these companies will go global at some point of time. If you see the history of evolution of global companies, that is how it has happened. If you look at some of these larger companies across other countries, be it the Chinese companies or some of the Korean companies, which are pretty large now from global standards, they had a favorable, they were national champions. And eventually, over a period of time, they went global and they became pretty large from a global perspective also. So you're right, and I agree with that. That's I see a lot of Indian companies taking much more, being much more ambitious and willing to take much more risk to step out of the home country because the home country has given them meaningfully large business cash flows and a strong balance sheet, and they've used all of that to build capabilities and a strong business. And now they can certainly take that capabilities global. All of us know Tata's own JLR recently they bought out the fourth largest commercial vehicle player in the world. So now with that, Tata Motors is now if that acquisition gets done in the next 6 months or 9 months, Tata Motors will become the third largest commercial vehicle player in the world, and they will be the second largest in Europe as well. The second largest commercial vehicle player in the Europe. Now that's pretty meaningful. So yes, these companies will go global because eventually we'll have to do that. But all I'm saying is they will go global not because they're constrained of growth in India. No, we have not reached that stage. They will keep growing their India business. Okay, India will keep growing, but given the kind of strong balance sheet they have, strong capabilities these companies have built, and they will grow global because they will become more ambitious, and probably they have a rightful case as well to emerge on the global landscape. So I certainly see that happening, Neil. And I think that will be for good. It will not be out of constraint for domestic growth, but it's all about doing more and probably becoming bigger and bigger in that sense. So I thought I've answered your question. With that, maybe friends, we're already 40 minutes into the conversation. So I'll take a pause. I'm happy to answer any questions you all have so that you can make it more interactive. If you'll have questions, probably you can just raise your hand and we can go by one to answer your questions, or you can type the questions in the chat box and we can pick it from there.
Any queries? You could unmute your line or raise your hand.
Yes, sir. Sachin here. Hello.
Yes, Sachin. Hi. Tell me.
Hi, sir. Good evening, sir. Sir, I just want to know our portfolio is a replica of PMS, almost 80%. The 20%, what you mentioned about derivative, can you just elaborate that?
So, as I said, derivatives will use opportunistically, Sachin, because let's say let's say, for example, we own HDFC Bank in a portfolio and we intend to own it for the next 5 years. There are a lot of times when the options market misprices. There's significant mispricing that happens in the options market on our underlying stocks, and because in PMS we do, because it leads to derivatives transaction clients accounts and there are constraints on leverage, we never use that and we let go of that opportunity. But now that we have a fund structure, wherever those mispricings are there in the market, one, we clearly want to use those and not leave that money on the table. So on our underlying stocks, wherever we see mispricing in the derivatives market, we'll use that one. And secondly, at times markets do get irrational in the short term, where markets fall very sharply and we think that markets are being irrational. Probably we'll use it sometimes opportunistically to double down or increase our exposure through leverage on our existing holdings as well. So combination of two, we want to use. So leverage is more opportunistic for us. It's not necessarily compulsive, but we want to use wherever we can for where we think risk reward is favorable and we can enhance our returns of existing fund. We certainly want to use that and not leave that opportunity, let go of that opportunity. Yeah.
Thank you, sir.
Yeah. Any other questions, friends? Happy to answer. I can see some
Suresh here.
There's
Hi,
a
sir.
Hello.
question in the chat box. We'll just complete. It's just unlisted shares will be there in the portfolio, Pankaj.
Yeah, we have a provision for 10% pre-IPOs in the fund, but so far we've stayed away from that. But if we come across right opportunity which is more appropriately priced, we can certainly look at that. So we have a provision for 10% of the fund a year, and that to pre-IPO. So which effectively means the company has to get IPO'd within a year's time from our investments, kind of thing. But we are not going to do beyond that. We are not going to do private equity in that sense. No.
Yes, Jasmeet, over to you. Jasmeet, you can go ahead.
No, ma'am, no question.
Okay.
I think we had Suresh had a question.
Yeah,
Yes.
Suresh.
Yes, Suresh, I got it.
In our portfolio, everything is a large cap. It's not in mid cap. All stocks in from large cap only, right? 50, 100.
This is a large cap portfolio, so about 80% of the portfolio will be large cap.
No, we are our following benchmark is Nifty 50. TRA is there, no? That's why
Yeah,
my
that's right.
question.
Yeah,
No,
that's right.
TRA 100 or TRA 50 only we are following.
TRI 50, Nifty 50.
Okay, sir.
Sure.
Pankaj, there's a question in the chat box from Jay saying, why focus only on large caps? Why not include quality, mid and small caps? I think Pankaj has just answered that query. There would be about 75 to 80% large, and we could selectively look at small and mid caps for the balance 20-25%.
Yeah, and we obviously, all of you know, we have our flexi cap fund now open in AIF structure as well. We run a slightly higher mid and small caps at 40%. So clients wanting a flexi cap structure, we already have a flexi cap fund. And in the large cap, idea is to run 75-80% large caps.
एग्जिस्टिंग पोर्टफोलियो से है सर, एग्जिस्टिंग पोर्टफोलियो से क्या कितना ओवरलैप होगा ये?
Existing opportunities PMS से 80-90% overlap होगा मनीष.
थैंक यू सर.
Sure, thank you. Any other questions? Happy to answer, friends.
Sir, I have a question.
Sure, Sandeep, go ahead.
Sir, I am following the CAGR return for the mid cap and small cap for the last 5 years. It is for the last 5 years, average small cap return is 32, 33, 35 in the range, and this mid cap in the range of 30%. But in the large cap, it is coming down to 20 to 24, 25%. I am speaking about the mutual fund returns. So why the small cap story will continue? It is proposed that the small cap story will continue for maybe another decade. So why at this stage I will incline to the large cap, leaving behind the small and mid cap. Some risk elements are there, but when I'm investing for a 5 to 7 years time or 8 years times, and it can be neutralized time effect and accordingly the risk effect. So can you just tell me that why I will skipping the mid cap and small cap? I will invest into the large cap.
Well, Sandeep, you're right that mid and small cap over the last 5 years have given pretty healthy or pretty high returns. But one, I'm not saying not to invest in mid and small cap. That's not the point. In fact, as I said, despite being a large cap fund, we are going to run 20% of the portfolio in mid and small caps. So that reflects the underlying thought process. But having said that, we also need to understand that mid cap, small cap over the next 5 years cannot give similar returns as they've given in the last 5 years. There is a significant part of returns that have come in mid and small cap in the last 5 years have also come through P re-rating. Now that re-rating is behind us. From here, it will be earnings growth driven returns. And a lot of companies which are not able to deliver returns will experience earnings de-rating. So be that as it may be, one, I think the comparison you're making is not correct because next 5 years, I don't think so mid and small cap will give the similar kind of returns as they give in the last 5 years. And secondly, yet the client needs to do at the client level, you'll have to do asset allocation for your client, right? You cannot have 100% of your client's portfolio in mid and small cap. I think if you do, that's a very high risk strategy for client's portfolio because when markets fall and markets will fall all of a sudden without giving any advance warnings, those large mid caps and small caps can fall very sharply, right? And the risk to the portfolio can be significant. So I think there's a place for large caps in every portfolio. Now, how much that large cap is appropriate will obviously vary from client to client, depending on the profile of the client, including his age, income level, risk appetite, return expectations, and all of that. So I certainly believe that large caps have a place in the portfolio, every portfolio. And I don't think so this portfolio could be any different in that sense. And for that matter, and which is where this fund will find a place in every client's portfolio. Now, advisors like yourself will do the asset allocation in terms of how much of clients' money you want to have in large caps, but this is where this fund will find that place in that large cap part of the portfolio of the client. Is that clear, Sandeep?
Yes, definitely.
Sure.
Thank you.
Thank you. We have हाँ मोहन जी अरे
हाँ जी, हाँ शंकर जी, कैसे हैं आप? बढ़िया
मैं
बढ़िया
एकदम बढ़िया हूँ, कैसे हैं आप?
एकदम शानदार सर। मैं ना आई एम अ फर्म प्रमोटर ऑफ AIF and in fact I go and tell clients that instead of investing in this PMS, invest in this AIF. It is going to replicate the strategy, but what I am getting to know is it will be 85% of kind of 80 to 90, so 85% of overlap, like in large cap also that we will be doing. So I have been advising on flexi cap to the people who want to invest in INR through Renaissance only. Now I have only two queries. One is that you have any slides or something or presentation which you can give it to me that why AIF is better than PMS from a customer's perspective, or probably a comparison in a sense that I can promote AIF more than PMS. Because for NRI clients, the documentation is also easy, the ticket size is also on the higher side, and I go ahead and tell them that I want you to go more than 5 CR so that charges also change. And then over 25 CR, the charges will be even less.
Sure.
Any presentation you already have, or if you can make and share.
Yeah, sure. I'll have Alok and Krishna from the product team ना मोहन जी, मैं उनको बोलता हूँ एक आपके लिए बना के अलग से एक 2-3 स्लाइड का और वो आपको अलग से भेज देंगे। आलोक एंड कृष्णा को मैं बोलता हूँ प्रोडक्ट टीम से, वो लोग आपको बना के भेज देंगे। ये आपके नाम पे $100 मिलियन का टारगेट लिख दिया आलोक ने हमारे बिजनेस प्लान पे, और आपके लिए हम लोग फंड भी लेके आ रहे हैं जल्दी नेक्स्ट मंथ, so we can tap your global clients.
Correct. So we will work on both the sides. One thing was that. Second is one more question, and that is on the allocation in the large cap or that taxi cap piece. You did say that you have provision, you keep provision for 10-15% of investing in some other alternate classes, but you have not done anything, but it is a provision that you have with you, right? So you are saying that you might invest
हाँ,
in something like
that's
that.
right. And that's primarily because क्या हुआ है ना, ये आईपीओ मार्केट में बहुत ज्यादा फ्रॉथ है।
हाँ,
मतलब अभी आप देखेंगे, मैं एक डेटा अभी मैंने कुछ दिन पहले देखा था, लास्ट 1 ईयर में 70% आईपीओ बिलो द आईपीओ प्राइस नाउ ऑलरेडी।
yes.
सो क्या हो रहा है कि आईपीओ प्राइस में बहुत ज्यादा फ्रॉथ है। एज इन्वेस्टर्स हम लोग थोड़े से कॉन्जर्वेटिव इन्वेस्टर्स हैं, तो पर ऐसा नहीं है, हमने फंड में प्रोविजन रखा हुआ है, जब कभी भी कोई अच्छी अपॉर्चुनिटी आएगी जो कि हमको लगता है कि ऑलरेडी लिस्टेड कंपनी से मच बेटर है और उससे अट्रैक्टिव वैल्यूएशन मिल रही है, तो हम लगाएंगे। पर अभी फिलहाल क्या हो रहा है ना, हम लोग भी काफी सारी डील्स या ट्रांजेक्शन देखते हैं, पर 95 हमारा रिजेक्शन रेट इज 95%। 95% ट्रांजेक्शन कर देते हैं, बिकॉज या तो वी डोंट लाइक कंपनीज, या फिर द आस्किंग रेट और वैल्यूएशन दे आस्क इज फार हायर देन व्हाट वी आर कंफर्टेबल विद,
Maybe in
बिकॉज
fact, I am of the same opinion as you, and I tell my clients that we don't invest in IPO. So I, as a fund manager, also don't take IPOs. And at the
राइट
same time, I promote you as if that you also don't invest in IPOs. So yeah. So I am aligned with that. I would in fact be on your side that please, instead of 95% reject 100% of the businesses, go only on the listed stage. Yeah, that is just my view, but then we are all aligned with whatever you do. I'm more than happy with
Yeah,
the way things
meaning
are.
if we get great opportunities, why not? We'll invest, but there's no compulsion for us to invest.
And
So,
yeah, and just one feature question I had that in PMS we have a provision of systematic transfer plan. Like we invest in say tranches. So people who invested in tranches have got a little better return because the market went down in between.
right.
Whereas people who started had a different opinion. So now I am getting a referral and I wanted to push him to AIF. AIF doesn't have this optionality, right, for STP.
No, we can do STPs. The first 1 crore has to be made because
Yeah,
that.
that is the issue. Yeah,
हाँ,
so I am putting them in in AIF because he will then start with 1 CR. Otherwise, in PMS he has that option. So
yeah,
in
but
that
the
1
first
CR
1
we
crore has
don't
to be
have.
put, and the STP can be done on top of that.
Yeah, no, that I understand. But in 1 CR, it is regulatory requirement, or we can look at something like that in future.
No, we cannot, because the minimum requirement in AIF regulatory is 1 crore investment. So the first investment of the client has to be minimum 1 crore.
And because of the nature that the NAV is same for all the mutual people, that's why we can't
Yes.
say that, which we
Yes.
can do it in BMS. Thank you
Yeah.
so much, sir. I had only this question. I attended your last quarterly update also, so I'm aligned on most of the things. Thank you so
Sure.
much, Pankaj ji. Keep doing
Thank
the
you.
good work. Yeah, thank you.
Thank you so much.
Pankaj, couple of questions in the chat box. Someone as an extension of this has asked, can we do a drawdown structure? So just wanted to clarify that this is an open-ended AIF. So unlike a close-ended AIF where we could do a 10 installments of 10 lakhs or 4 installments of 25 lakhs, this would need to start with a minimum of 1 crore. Over and above that, the client can stagger. I think that was one of the points that Pankaj ji was making. We'll take one or two last questions, Pankaj. I'll combine a few questions which are around some of our sectoral allocations in light of, the recent unfavorable news around the tariffs coming out of the US. And we have 2, 3 different questions, but basically they're asking what would be the impact of the Trump tariff regime, and within that, there's pharma, auto, IT, some of these feature in our portfolios. And how do you expect the impact of that going forward?
Sure. So all of us know, friends, that classical now Trump playbook of negotiating and creating pressure. So I think, meaning from my point of view, from my understanding, I still believe there is a bilateral trade deal in the pipeline between India and US, probably in the next 8 to 12 weeks or something like that. And obviously, it's a hard negotiation that US is doing, and it's creating pressure. Now, whether this incremental tariff of 25% is to punish India or is to create incremental pressure on Russia to agree for a ceasefire, it's a mix of both. So yeah, that is how, meaning I'm sure most of us in India or Indians don't like it, but that is how the US president is, and that's his way of doing business. And being US, they can get away with anything, at least for the foreseeable future. But though I certainly think not forever, some point of time there'll be payback for them. But at least for the foreseeable future, they can get away with anything. So one, presuming that the tariff remains at 50% and there is no trade deal, which is not my base case, then it shaves off 60 basis points of India's growth. So India's growth, which was expected to be 6.5% real GDP growth for this year, will go to 6% this year. I don't think that's not my base case. I still think there's a trade deal, bilateral trade deal between India and US. It's more important for India as well. I'm not a diplomat, but from my understanding of it, it's very important to one. So at 50, 60 basis points of growth impact, what I really want to say is India can deal with it. It's not the end of the world for India. India can deal with it. There'll be impact. I'm not saying, I don't want to trivialize by saying that there's no impact. There is an impact. There is a serious impact on certain few sectors, including textiles, gems and jewelry, to some extent on auto exports, engineering exports and all of that. But India can deal with it. There was a point of time when India was today we are a $4 trillion economy. There was a point of time when Indian economy was 1/10 of this, $380 billion. India had the courage to declare itself as a nuclear power. Then Mr. Vajpayee was the Prime Minister of India. He did a nuclear test and he declared to the world that we have nuclear power. Don't mess with me. And the message was more to our neighbors. Don't mess with us. The same US imposed economic sanctions on India. Like, for example, they have sanctions on Iran today. I was still 2.5 years in my career. And I very distinctly remember Financial Times London ran a headline the next day, India is dead. So Trump is calling India a dead economy after 27 years in 2025. Financial Times ran a headline in 1998, India is dead, US imposes sanctions on India. So at what cost is India trying to become a nuclear power? At the cost of the lives of their 1.2 billion people. That point of time, we were 1.2 billion. They said, you're sacrificing the life and the future of 1.1 billion people. We dealt with all of it, and the same US became a strategic partner, a great trade partner for India in the last 25 years. It's India's time in the world. We are the fastest growing economy in the world. As we grow bigger and bigger, we will face economic challenges. There will be economic pressures, political pressures to contain India, just like US is trying to contain China today. The important thing for all of us is to deal with all of this very firmly, and not to buckle down. We are not a cowboy economy or a slow or a small economy anymore in the world now. We are the fourth largest economy in the world. Yeah, we are 1.4 billion people. We can take care of ourselves. And we are the youngest democracy in the world. So the point I want to tell is while there'll be give and takes, it's important for us as country to stand on our own and get a deal. Probably we might end up giving some more concessions to US because they're creating so much of pressure. We want to deal with them. We want to do business with them because they are the largest economy in the world at $30 trillion. And we might have to give some more, but yet not completely buckle or succumb. And it's not the end of the world for India. We can deal with it. We've dealt with US economic sanctions, which was much worse than 50% tariff in an economy which was much smaller, 1/10 of our size, 1/10 of the current size, $380 billion. We were in 98. And US said, not tariff, they said economic sanctions, no business with India across anything in the world. Yeah, and they shut us out of the world. Once US imposes economic sanctions on any country, 70% of the world stops doing business with that country. Okay, so 70% of the world was close to us for business, and we dealt with them. And all those US companies are today here. They want to sell their iPhones to you and me. They want to sell their cars to you and me. They want to sell their whatever, I don't know, fashion, but all their fashion goods and apparels to you and me. They want your and my money, because we are going to be increasing our consumer spend the fastest in the world over the next 20 years. The next consumer miracle is happening in this country, as 1.4 billion people will become richer and prosperous. So they want a lot of things out of us. Yeah, government of India is wise. Indians, meaning Trump can be a maverick. We are wise people. Government of India also has a lot of cards in their hands, but we don't want to be announcing policies on Twitter, meaning only a maverick and irresponsible person can do that. If you want to announce policies, if you want to retaliate, we will do it in a more dignified manner, yeah, with grace, yeah, not in an undignified, ungraceful manner. This is not a meaning. I know all of us know Trump gained his popularity from TV show, but running a country is not a TV show or a popularity contest. So if India has to do it, India has cards in our hands. We can do a lot of things. Okay, today uh, all the tech companies, Google, Meta, make billions and billions of dollars of profits out of India, and we don't tax. They don't pay tax. What taxes they pay here is negligible. Yeah, because they're booking all the profits in US. So they are already taking a lot of things out of this country, out of your and my pocket, and they want more of it. So I think we should trust our government. I think Indian policymakers have been very wise in terms of dealing with situations like this. So not to get too worried about it, and give the government, all I'm saying is give the government the space and room to do the negotiation on a deal which is reasonably good for India as well. And I think which is what I think we should applaud our government to be able to stand on their terms and not to succumb to this thing. Short term, it will have some impact. I think the larger impact is on not to get to specific sectors. I thought I'll give a larger answer to this question, because since yesterday I've been getting a lot of questions on this. So I thought I'll give a larger answer. Specific sectors, I think the more impacted sectors are sectors which are more labor intensive, textiles, gems and jewelry, because there for the US customer, it's very easy now to switch. For a textile buyer or a Walmart or some other textile buyer in US, it's very easy to switch his supply chain or his production from India to Vietnam, because Vietnam is 20, India is 50. Yeah, so or to some of the neighboring countries. Or for auto parts, it's easy for American buyers to switch to Thailand. Or so I think there'll be an impact on more labor intensive. Some specific companies on auto ancillary can get impacted. Pharma, until he does something on pharma, I don't see pharma getting impacted, because pharma is exempt from these levies for the time being. India is the lowest producer of drugs. 60% of US drugs or medicines are manufactured in this country. You move that to any other country in the world, the price will go up. Their healthcare bill is already under a big political hot potato and is significantly out of their budgets. And one of the bigger challenge for every successive government, right from Barack Obama, has been to contain the healthcare bill. Anywhere you move out of India, their global production. So they're not talking about that. The fact that we are subsidizing by using our labor, our skills to provide medicines every year on a day-to-day basis to American citizens at the lowest cost. Yeah, you impose taxes on that, do that, let American companies move their production out of India. Not possible, because anywhere you go, the cost will go up, and eventually we'll have to pass it on to the consumers. So pharma, I don't see getting impacted, nor do I see IT getting impacted because of this. IT is getting challenged because of other things in terms of concerns on AI, and there's a slowdown in discretionary spends in US. So the growth recovery in IT has got delayed, but not because of this. So I don't see IT getting impacted because of this. Sorry, but I thought since a lot of people have asked this question, I thought I'll give a slightly more comprehensive and a long-winded answer to the question.
Thanks, Pankaj. We are already over an hour, so I think we'll close our session here. Any other queries, please feel free to write into us. We have offices in most of the key cities, and I hope our teams are in touch with you. But please stay connected, and thank you again for giving us this time to allow us to take you through what we hope to do with the new fund. In a way, a natural extension of our 6-7-year-old PMS strategy, which has been very successful. So with that, thank you again, and hope to have all your support as we get this fund up and running. Thanks, Pankaj. Thanks, everybody on the call. Have a good evening.
Thank you, friends. Thanks a lot for your time this evening. I look forward to all your support for making this fund really successful. Thank you.
Thank you.
Thank you so much, everyone. Thanks, Shalini.
Thank you.
Thank you.
Thank you.
Thanks.